Good morning or afternoon. My name is Kyle Wilson. I'm portfolio manager here at SIA, and I'm joined by Chief Market Strategist Colin Szynski. We're going to provide you with an SIA Wealth Management update going into the final month of 2022 and discuss a little bit about what's happened in some of the portfolios lately. So the agenda for today is, first we're just going to take a look at SIA Wealth's true tactical investment approach. We'll also discuss how this has impacted some of our funds over the last month as well as so far this year. And following that, Colin will jump in and share some market insights. So true tactical in action. True tactical is really just a unique asset allocation risk management approach which utilizes quantitative and technical market signals to guide our investment decisions within managed funds. The first and primary indicator, as many may be familiar with, is the SIA chart's equity action call. The EAC provides us with some insights into the level of risk in equity markets. So the various colored zones, green, yellow, and red, can influence our tactical decisions around how much equity exposure we want in our portfolios. And essentially, as the equity action call increases, we look to increase the equity exposure in the portfolio, and vice versa. As it decreases, we look to decrease equity exposure. So far in 2022, we've seen several zone changes, with the latest move in November here, coming out of the red zone through the yellow zone and back into green, which has triggered a tactical shift in lots of our portfolios back into equities. On the right side is the asset class rankings. The asset class rankings provide some insights into which areas, asset classes, or markets are exhibiting strength, and we look to align our portfolios with the strength. The most recent moves pushed U.S. equity into number 1 and international equity into number 2. For a little additional color into how we interpret the zones of the equity action call, with green typically being more bullish towards equities, red being more bearish, with the yellow zone providing a bit of a buffer or transition zone, depending on which zone previously came out of. So how has this impacted true tactical, even over the past month? So here's a timeline of some of the recent changes. Over the past month, broadly speaking, in the portfolios, we've tried to take advantage of opportunities as they presented themselves. So first, with a slight shift into energy equities at the beginning of November on the 2nd. That was followed by a more broad deployment of capital on November 21st, with a final move back to 100% target equity right at the end of the month. And with that, the 4 BMO funds that we manage that are impacted by this, we've seen the global equity, Focus Canadian equity, and Focus North American equity top back up at 100% exposed, as well as the tactical asset allocation maximized at currently sitting 60% equity. So within the global equity portfolio, which is a mix of broad-based ETFs, sector-based ETFs, as well as some individual stocks, as such, we've taken a liking to financials with the highest weight there, followed by industrials, energy, consumer staples, and healthcare, which make up approximately 77% of the portfolio. Taking a look at the performance, so far, in 2022, it's been an extremely uncertain and unpredictable year. So we feel that we're, extremely pleased with the return profile across all of our mandates relative to benchmarks and peers, both on an absolute basis, more importantly, maybe on a risk-adjusted basis. So this can be seen here with the global equity delivering on downside protection, as well as volatility management relative to the benchmark. And through the end of November, the portfolio is still slightly negative, down about 3.28% there. For the Global Asset Allocation Fund, the equity mix is similar to that of global equity on the previous 2 slides. Now, the exception here is the fixed income component, which is currently sitting at 39%. Not only has it been a tough year for equities in terms of volatility, but we've also seen some volatility and downside to the bond market as well as interest rates have risen. We still see, or believe we've seen a pretty favorable return profile for the asset allocation fund, both from a volatility management and downside protection standpoint. Relative to the benchmark in November here, we've got the fund sitting at down just a little bit less than 6% there, but still got a bit of a gap on the benchmark, which we're excited about. Next to the 15 stock focused North American fund, we do see similar exposures with sectors like energy, financials, healthcare, and industrials rounding out the top 80% of the portfolio, followed by some consumer staples, materials, and real estate. This portfolio actually ticked back into the green for year-to-date return, once again delivering on that risk management piece that we feel has been so critical in navigating 2022. And lastly, of the impacted funds, the Focused Canadian Equity Fund, this one with the highest weight in industrials, followed by energy, consumer discretionary, and financials, and some small exposures to materials, technology, and consumer staples as well. This fund's also tipped back into the green here year to date, just above that 1% mark by the end of November. And with that, I'll flip it over to Colin for some market insights. Thanks.
Market insights portion of our presentation today. My name is Colin Szynski, Chief Market Strategist with SIA Wealth Management. We've talked a lot about market uncertainty this year, and this quote is often we've used a few times. Everyone has a plan until they get punched in the face, and that comes from Mike Tyson. And what's important with this is that a lot of plans this year have been upended, in particular for investors that have been long-term buy and hold, or balanced investors, or people with long-term strategies. But it's not just the bulls that have had a difficult year. Even people that are bearish have had to face some significant changes and bear market rallies and big bounces, and we've had big swings really in both directions. So in this case, it's been a challenging year in many ways for everyone. But important thing is to remember this applies to both bull and bears. It's important for investors to be prepared to make tactical changes as market conditions evolve. As you noted here, the bull markets and bear markets don't travel in the same direction all of the time. And action, particularly in the S&P 500 in 2022, highlights the importance of not being complacent, not overcommitting to either being a bull or a bear, and the key importance of being tactical, to be ready to seek out opportunities when they present themselves, as well as managing risk exposures. So if we look at this chart, we've seen in the over the course of 2022 to date, up to the 30th of November, 6 swings of more than 10%, 3 downswings and 3 upswings. And one of the downswings between March and June was actually over 20%. In comparison, in 2021, there were only minor corrections. The market was up trended upward for most of the year. There were a few corrections of around 5%, but no downward moves that exceeded 10% in 2021. This year, in comparison, so it had one move of over that time, and this year we've had 6. So it's a huge difference and a huge change in the tenor of the market, and because of that, the importance of tactical investing, and as I said, being ready to step out of the market when needed and to step back in when opportunity presents itself. More recently, opportunity has started to present itself once again. The SIA chart's equity action call has moved back up into the green zone, which is an area that has historically shown to be more favorable for equities. And the reason this has happened is because we've seen significant moves up in the relative performance of U.S., international, and Canadian equities relative to cash, commodities, currencies, and bonds. And what was interesting for most of this year, about the equity action call spent about 10 months in the yellow and red zones. In comparison, in 2015-16, it was about 8 months, and in 2008 to 9, it was about 18 months. So that's a pretty significant stretch of time, and so now we have moved back up into the green zone. The relative performance of asset classes has tipped back in favor of equities, and so because of this, we've seen what we wanted to mention was a shift in focus here among investors from inflation and interest rates to the economy. I've mentioned the upturn in the equity action call and in the relative strength of equities, and the reason why we've seen that happen is because the direction of interest rates and the tone of the hawkishness among central banks has changed a little bit. Central banks have got caught flat-footed behind the curve on inflation, have been rushing to catch up, and now more recently they've started to talk about slowing interest rates and interest rate hikes. And as they've done that, people have started to look ahead to the end potentially at some point of this current interest rate hiking cycle. But what's important about this is that just when the central banks stop raising interest rates doesn't necessarily mean it's the end of the bear market. And this was something we've seen in the past, where in terms of the Fed funds rate, the Fed funds peaked in June of 2000 in the 2002 bear market. The Dow Jones peaked in December of 1999, but the Dow Jones didn't actually bottom out until September of 2002. Similarly, from the 07 to 09 bear market, Fed funds peaked in June of 2007. The Dow Jones peaked in October of 2007, and the Dow Jones didn't bottom out until March of 2009. In the most recent bear market, even, we saw Fed funds peaked in April of 2019. On a monthly close, the Dow Jones peaked in December of 2019, and the Dow Jones bottomed out in March of 2020, and that was from a massive amount of supportive stimulus from central banks that turned that one around so quickly. In terms of the current cycle, the Dow Jones peaked back in December of 2021. We have had a bottom in September of 2022. It's unclear if that's the bottom or if it's just an intermediate term bottom within a larger bear market. But we've seen that at the end of September, the monthly close was down 20.9% over on the year, whereas by the end of November it was down 4.8% on the year. Both of those numbers are from December 31st, so it's of 2021. So we've had quite a bounce in the markets in the last couple of months, and while this has been going on, that's encouraging. But what this tells us for investors is that it's important to remain vigilant. It's important to keep our risk controls going, to take advantage of the opportunities while they're here and while they're presenting themselves, but not to get complacent. We've talked a lot over the last year or more of the double bubble, the issues of a bubble in debt markets, a bubble in stock markets, and really bubble in real estate and in other markets as well. And it's certainly something that has played out over the course of 2022. And what I'm mentioning here is that these issues haven't completely gone away, but how markets look at them and respond to them may change in 2023 from 2022. So, for example, if we look at the debt bubble in 2022, it's been all about central banks. It's been all about corporations, consumers. In 2023, we may see more of a focus on housing and commercial real estate. And in particular, we've seen the housing market slow pretty dramatically as interest rates have moved up. Number two, in terms of stock markets, we see a shift in what I call the PE ratio, and I've mentioned them here. You can on the slide. In 2022, the focus has been on market valuation, on P, on the price side of the equation. In 2023, depending on what happens with the economy, we may see more of a shift and focus on corporate earnings, on the E side of the equation. And that's something that goes back to my previous slide, where I talk about how the markets had actually in past bear markets, stocks have continued to go down after the Fed has stopped raising interest rates. And that's because what ended up happening was that the initial shock comes from the change in liquidity, but later on, it's if the economy falls into a recession and corporate earnings get crunched, then that has presented a second set of problems for stocks that could play out over the longer term. So far, the central banks have been hoping for more of a soft landing. We'll see if we get it or not. Number three is inflation. In 2021 and 22, it's been really driven by commodities, food prices, energy prices, and those sorts of things. But as we've evolved and moved into the later part of 2022 and heading into 23, the bigger issue is wages and core inflation, because food and energy as commodity prices, they go up, they go down. And when the central banks were talking transitory inflation, that was more because they were looking at commodity inflation that goes up and down. What they weren't, where they got caught offside was the increase in wages and in core inflation that came out of all of this. And those are what we call stickier. Once they go up, it's harder to ratchet them back down. And so that's the question now as we move into 2023 is, well, even if commodity prices come back down, what about wages? What about core inflation? What about services? What about the things that are a little hard? How do you get those components of inflation back down? And so that's the next big thing that we could see a theme play out in 2023. So because of that, we saw in 2022, in terms of central banks, everybody's been looking at the interest rates going up, how fast, when did they start, and so on, and how quickly are rates going up. Moving into 23, we've talked about how that might shift from the pace of interest rate increases to, well, what might be the pace of interest rate decreases, if any? Do we get any rate decreases? If we talk to the Fed, listen to the Fed, the Powell and Co., and to a certain extent the Bank of Canada as well, this idea that the central banks raise interest rates to a certain point and then they may hold them higher for a while until they get inflation under control. This isn't necessarily like the last cycle where as soon as the economy slowed, in the case of the pandemic, the economy slowed and the central banks rode to the rescue and drove down interest rates and drove up QE, and that might not necessarily happen this time. They're quantitative tightening. They may keep rates higher for longer. And then, of course, the other question is, well, what might the peak terminal rate end up being? So those forecasts have been moving up steadily over the course of this year, and even recently, Fed Chair Powell hinted that even if the pace of rate hikes slows, that the Fed's peak rate forecast or terminal rate forecast may still end up moving higher. So you may just see this rate hike cycle get dragged out for longer, and so that's an issue, and that's something else we're all keeping an eye on as we move into 2023. So we're going to highlight some things in the market here. First of all, the S&P 500 versus cash. As I showed a couple of slides ago, among the equity asset classes, U.S. equity is currently the strongest. The S&P 500 has had a really nice rally in the last few weeks. However, the only caution I have so far is that it looked good in April and it looked good in August as well. And those rallies kind of petered out, and we can see we've got this channel of lower highs and lower lows. And this current rally has carried us back up into the downtrend resistance line. And that's a key test that's underway right now. If we do get a breakout through here, that would be encouraging for the markets. It would highlight continued strength in equities and would suggest we're into perhaps a little more extended recovery this time. However, if we were to fail and turn down again from here, it would confirm that the longer term downtrend remains intact and suggest that the recent gain was another bear market rally. So at this point, we're really at kind of an inflection point where we may start to find out relatively soon of, has this been a bear market rally or are we into a more sustainable recovery? Stay tuned. In terms of international equities, we've also seen a rebound, and international equities actually had peaked before U.S. equities, and we're kind of declining through the latter part of 2021 while U.S. markets were still going up, and then they accelerated downward in 2022, as shown by the arrows in this chart. International equities have staged a significant rebound lately, but again, they've yet to break out of their longer-term downtrend. Among international equities, the recent rebound has been led primarily by European and more commodity-sensitive countries, while Asia-Pacific markets have been lagging behind, particularly Hong Kong and Chinese markets with ongoing lockdowns in China. International equities rallying has been good in terms of it shows that there's breadth to the current equity recovery, that it's not just a few big cap US stocks that are running. We're seeing strength in other countries as well. That's a positive. And also international equity on a relative basis may continue to benefit from a weakening US dollar, which we've seen come back down in recent weeks. And similarly, international equities were somewhat depressed by a higher US dollar previously. Now we'll look at the TSX Composite. So I mentioned when the market started to turn down that international equities peaked first in early 2021. U.S. equities peaked at the turn of the year, right at the beginning of 2022. And in terms of the S&P and the TSX Composite, the Canadian market actually didn't peak until April. And it's had a relatively moderate decline. It bottomed out in July, and since then it's been actually holding above its lows. The TSX Composite has benefited from its higher exposure to resource sectors, particularly the energy sector, which has been quite strong on a relative basis this year. And even though the price of crude has softened lately, energy stocks have remained relatively strong. I'll speak to this on another slide shortly. And more recently, the TSX Composite has launched up from a successful retest of support. Of the July lows have continued to hold. It's regained 20,000, and it's snapped out of a shorter-term downtrend. So far, so good for the TSX Composite. As I mentioned, there's been a bit of a divergence between crude oil and energy stocks, which I've shown here. Over the last few years, generally speaking, the overall longer-term direction of travel for crude oil and energy stocks tends to be similar, upward and downward, and they tend to trend in the same direction. But every once in a while, you get some fairly sizable divergences or gaps in performance opening up with the between energy and crude and energy stocks. And the arrows on right show that there's been a pretty large one has developed over the last number of months, with energy stocks continuing to trend upward while the price of crude oil has been trending downward. Now, I've circled two previous areas where we saw significant gaps open up. And in both those cases, what happened was that the price of crude oil moved back into trend with the oil stocks, almost as if the oil stocks were kind of showing the main trend, but being a commodity market, that crude oil around that sometimes has periods of higher volatility. So in 2020, we'll recall crude oil went down and at one point was trading negative, and then it bounced back. And then another point, we saw crude oil spike up earlier this year and then come back down to trend. So that's what we're seeing here. Historically, we'll see what happens this time. But as I mentioned, historically, it's been crude oil moving to back in line with energy stocks is what's happened previously. I wanted to highlight the changes in the U.S. interest rate. We saw a long-term, for the better part of 40 years, U.S. interest rates and inflation were trending downward. But this it seems to have bottomed out in early 2020, and since then we've seen interest rates propelled by inflation starting to climb back up. And so we did see this rate break out of a downtrend and continue to climb. Its recent peak was up above 4%, and it's come down to about 3.5, 3.6%. The next major upside is in the 4.9 to 5 area. The next downside support is around 3.35 or 3. And we've circled 3 corrections here, and these are pretty significant. The corrections we saw in the 30-year rate have been in April, in July, August, and in here in November. And the reason I note these is that these pullbacks in the 30-year rate have coincided with rebounds in the stock market. So where I showed on the S&P chart where we've had this great rally and now we're testing a downtrend line, well, where the S&P goes from here, one market we might look at for hints and insights is what happens with U.S. interest rates. If interest rates continue to come down, that may support continued gains for equity markets. If interest rates turn around and start going back up again, that could present a headwind for stocks. And our last chart I wanted to highlight here is the US dollar CAD. With interest rates on the rise in the United States, the US dollar has steamrolled over absolutely everything this year. US dollar has been incredibly strong, basically crushing all other currencies in its path. What's interesting is that number two has been almost a tie between the Canadian dollar and gold, and they've fluctuated a little bit around each other, but basically this an otherwise strong performance relative to most currencies by the Canadian dollar and gold has been obscured by the fact that most people compare them with the US dollar. Recent comments from Fed officials, including Chair Powell, about slowing the pace of interest rate hikes has started to spark a correction in the US dollar. And we've seen the US dollar CAD has moved into its largest downswing since the spring of 2020. Right now, US dollar CAD appears to be settling into a 130 to 140 range, but it's interesting. As I mentioned, we've seen strength as the US dollar has come off, as treasury yields have come off. We've seen equities rally, we've seen commodities rally, we've seen gold rally, we've seen the Canadian dollar rally, and other currencies such as the euro as well bouncing back. So it's important how the US dollar acts as a headwind or tailwind for other markets is another story that could be significant as we move through the next number of months. These are the fund codes and sales information for the BMO Global Asset Management funds that SIA Wealth is a sub-advisor for. There's the Focused Canadian Equity Fund, the BMO SIA Focused North American Equity Fund, the BMO Tactical Global Equity ETF Fund, the BMO Tactical Global Bond ETF Fund, and the BMO Tactical Global Asset Allocation ETF Fund. And finally, we have our disclaimer. So this will conclude my prepared remarks. We thank you all very much for joining us today.